So to sell or not to sell? And that is the million-dollar question for Alphabet investors. So regardless of at which point in time did you actually buy into Google, you are probably sitting on pretty healthy profits because we are currently near their all-time high figure. In fact, on a year-to-date basis, Alphabet is up roughly 65%, and from its recent 52-week low, it has more than doubled from roughly 150 to currently $315 per share. While we can't say the same for its closest Magnificent Seven or big tech competitor, Meta Platforms. On a year-to-date basis, it's clocked in roughly 7%, and the chart is as noisy as my girlfriend's mood. And also, it has severely underperformed the S&P 500, which has clocked in more than 16% over the last 11 months or so. Now, the question is, especially for early Google investors, is it time to take profits? Should we sell out of Google, hold it on cash, or in fact, even start to consider rotating our money from Alphabet to Meta Platforms? So I'll attempt to answer all these questions in this video, and what is the framework into thinking these two companies in today's market climate, not forgetting their most recent valuation run-ups or rundowns as well. Now, in full disclosure, this is the exact screenshot of my current portfolio exposure, and as you can see, just to dive into the two specific names, I am a current investor in both Google and Meta. Although Google Alphabet is a much larger exposure at roughly 10.9% and an unrealized gain of nearly double, while Meta is at a 3% exposure. And first things first, the natural question that we would like to answer is what happened to Google over the last few weeks or last few months? Why this sudden run up in valuations? So if I were to cast your memory back to probably the mid of 2024 or even until early 2025, we have seen multiple headlines, and I don't think it's foreign to any of you. We have news publications talking about how OpenAI announces its Google killer, which is SearchGPT, and in fact, other AI platforms are also thrown into the mix. And do you still remember one of the front contenders of this search platform, Perplexity? And people are even saying that, hey, Google is no longer the best search engine. And not only is Google dead, rivals may already be eating into Google search. And fast forward to 2-3 months ago, we are seeing the entire narrative change. Suddenly, we are talking about Google as being the hottest new AI company. And in fact, even Meta Platforms is also in talks to spend billions of dollars on Google's TPU chips. And to add the icing on the cake, do you still remember 1 to 2 years ago, the failed demo of Bard? Currently, within a blink of an eye, Google's Gemini is ranking first, at most second, on capabilities such as text, web development, vision, and even text to image. And for those of you who are not as plugged into this entire AI image gen space, personally, I'm an avid and active user. The image generation capabilities have really went through a step-up transformation, and I'm using it a lot more frequently. In a falling interest rate environment, it's rare to find a broker that pays you more for doing less. But that's exactly what Webull Singapore is offering their new users today. So if you deposit and maintain at least 3,000 Singapore dollars for 30 days, you'll get 70 Singapore dollars worth of Apple shares. And if you use my link below, you get an extra $30 of Apple on top of that. And for those of you with a larger capital size, looking for higher short-term yield on idle cash in this falling interest rate environment, Webull is basically playing center. Maintain a daily net deposit of at least 10,000 Singapore dollars and you unlock the base tier of 1% per annum interest being paid daily for the next 180 days, with the bonus rate actually scaling up as your capital goes up. Plus, you can earn an additional 1% per annum bonus interest if you complete 6 buy trades within those 180 days. So to crunch the numbers for you, if you're based in Singapore, you are new to Webull, you sign up using my link below, you deposit 10,000 Singapore dollars, and you make 6 buy trades, and simply maintain that amount for 6 months, which is equivalent to 180 days. In total, you'll get about 280 Singapore dollars worth of Apple shares, plus roughly $100 in interest from the 1 plus 1% per annum welcome rate over the next 6 months. And that's before any other potential returns if you choose to park the money in money market funds, ETFs, or even deploy them in this current volatile market environment. So this welcome offer is only for new Weibo Singapore users. So if you've been thinking about opening an account, I think this is the best time to do it. So use the link below to unlock the extra Apple shares and bonus perks today. So from this particular episode of Google's comeback, what can we learn from it? I think first things first, we have to congratulate and be happy for existing Google shareholder. But on a much more serious note, I think while it's easy to say it in hindsight of, I told you so, you should have just ignored all the FUD, average down aggressively and build out your entire Google position. But I'm not going to lie, personally, for my own investment journey, holding on to the stock over the last 3+ years were not easy at all. In fact, one of my earliest buys was during the 2022 inflation bear market. And while we are all very excited about the recent monstrous comeback of Google in the past few months, let's not forget that Google has been one of the Mag 7 underperformers from end 2021 to April 2025. In that period, Google was essentially flat. After 3.5 years, mind you. Of course, due to a myriad of reasons, but mainly because investors were voting with the dollar bills, thinking that GPT, OpenAI, or any of the other AI tools were out to kill the search golden goose. And despite quarter after quarter of Google reporting stellar earnings, bring in decent growth rate and profitability, investors were still not buying the story because the future indeed looked extremely uncertain. And I believe anecdotally, like many of us that are internet natives, if you were to just observe yourself objectively, looking at your own search habits, it seems like the bear thesis back then was extremely convincing and Google search was really in trouble and was under siege. There were definitely some small elements of blind conviction plus a bit of luck. But I think the main key learning point here is more about identifying the core principles and factors that will move the needle and then constantly stress test the worst case scenario. Back then, my idea was simple. I'm looking at Google search. It's true that my habit started to tend more and more towards ChatGPT or the likes of them. Was I or even am I able to execute transaction-related activities or high-value transactions that is attributable to advertising through ChatGPT or the likes of them? The short answer is no. A lot of my high-value transactions is still via Google search. And while the story or the general consensus amongst Alphabet is that Google is done for, Google was able to maintain the market share in terms of attribution, the ad network, and the specific activity that is related to commerce or transactions, then I think the profits are still intact. If not, whatever that's being so-called competed away were low-value searches and informational-related searches, which does not lead to the bottom line of Google. And everything else about selling chips, about Waymo, all these are considered core options. I only needed to focus on the core money printer and whether the search business is going to be disrupted. And in fact, in the lead up to this huge run, there are more and more endorsements coming in for the company itself. In a recent interview that Elon Musk went on, he was asked where he would like to invest. So for him, he said that I don't buy stocks or manage a portfolio. I just build companies. But if I had to pick, he would pick Google, which is the AI groundwork and insane future value, and Nvidia, and anything crushing it in AI, robotics, or spaceflight will own almost all the value. And just within a snap of the fingers, Google has suddenly turned into a full-stack AI company. And not only that, Berkshire Hathaway, which was run by Buffett himself, I think, yes, he's stepping down soon, but they did just recently acquire a $5 billion stake in Alphabet in the previous quarter. So in Q3 of 2025, when you look at the range of price that Google has traded, it was roughly between 174 to 256. And today, the share price has already jumped to 315. Of course, there is a certain level of biasness and a Buffett effect because once Berkshire announced that they had a Google position, the share price also gapped up because there was some sort of a stamp of approval from Buffett's team. But whether was it Warren Buffett pulling the trigger will remain a mystery. Now, looking deeper into Google's numbers, I think existing investors are most probably just concerned about the recent very rapid expansion in earnings multiples. Because we all know that in the short term, the market is a voting machine, but in the long term, it's a weighing machine. And no doubt that in this very recent run-up, a large part is being pulled out due to multiples re-rating. It just means that investors are willing to pay a higher price for Google's business today. Because let's not kid ourselves, within 2 quarters, how much more can Google's earnings actually grow? Unless they are posing in triple-digit growth rates like Nvidia. But that's clearly not the case. And in fact, I've actually just pulled out the past financials of Alphabet. And over the last 10 years, they have essentially grown their operating income from roughly $19.4 billion to $112 billion. And that's a CAGR, or compounded annual growth rate, of roughly 19%. Most investors are more worried about this tail end or the right tail of this few valuation matrix. And I've essentially put out a few of these so-called valuation multiples. So in green, you have the price to free cash flow. In purple, you have the price to earnings ratio. And in orange, you have the price to operating cash flow. And I think at one glance, you can see that regardless of how you're going to draw the line, whether is it from the mean or the median range, some of these numbers are clearly looking a little bit out of whack. And I think across the last 10 years of its history, using a historical lens, the price to free cash flow has never been higher. But I think for good reasons. Especially so because a lot of all these hyperscalers are now investing very heavily into their physical infrastructure, buying up the chips, building up the data centers, and all these related expenses will come out in the form of capital expenditure. And hence, it will hit the free cash flow, and why you see a 51 times free cash flow. And you just do an inverse, that means that Google is roughly trading at a 2% free cash flow yield. I think unless it's a very, very high growth company, a lot of investors would agree that that is on a much more expensive end. However, if you actually ignore for a moment the free cash flow profile, but focus more in terms of the earnings and also the operating cash flow, you can see that it kind of tells a different story. And in fact, at their current levels, I'm sure it's definitely still on the higher side of the band, but it doesn't look extremely ludicrous, or it doesn't look like ridiculous. In fact, if you just draw a very quick median line across the purple range, you can kind of argue that we are near their median. And of course, there is this segment between 2017 and 2018 that looks a little bit out of whack. But if you just ignore them and to take a median line here, you could argue that 31 times earnings is probably where Google has historically traded at. And it's a similar story for the price to operating cash flow. It's definitely on the high side, but not so ridiculous until it's out of band, like the free cash flow profile. But I think one more important thing that I wish to point out is that if you do observe the growth of the operating profits plus the last 12 months, they grew at a CAGR of roughly 21%. And if you compare it to the stock price grew at a CAGR of roughly 24%. And that excess, you can consider it as some sort of a valuation multiple expansion. And if you were to actually just look at some of these numbers, like I've already suggested, the price to free cash flow will look inflated because the base of the free cash flow is kind of subdued. So yes, it's indeed true that valuation multiples expanded by a little, but is it really considered so overvalued that it becomes unjustifiable? I don't think so. But I would concede to the fact that Google is definitely on the higher side of its historical valuation. But is it the same company today versus, say, 8 to 10 years ago? I would also argue otherwise because of the new levels of optionality and discovery of the business fundamentals. We have to compare and contrast it to Meta as well. So likewise, I've also put out the last 10 years of their operating profits. They grew at a CAGR of roughly 24%, and I contrast it with 3 of its different valuation multiple. In green, it's price to free cash flow. In orange, red, it's price to earnings, and in purple, it's price to operating cash flow. Similarly, I think I put the price to free cash flow chart there so that you can have some sort of a balanced view. But we all know because due to these big investments will look relatively inflated, but comparing it to, let's say, their price to earnings and also price to operating cash flow, Meta is clearly much more closer to the median range than versus Alphabet. Of course, not forgetting the episode back in 2021 and 2022 where Meta and Mark Zuckerberg was essentially experiencing some sort of an identity crisis. And if you remove the segments of these kind of crazy volatility and try to get a normalized range, I think Meta is trading closer to median, or some might argue even lower than median. And in a similar vein, for Meta platforms, their operating profits grew a CAGR of roughly 24% in the last 10 years, while the stock price actually grew a CAGR of only 21%. So that delta, or the difference, is usually due to multiples contraction or investors not willing to pay up, I think at first glance, I might be tempted to think that, oh, since Google was re-rated so quickly back up and Meta is still languishing at the bottom, it seems that one is clearly overvalued while the other is undervalued. And it might potentially be a good time to make the switch. But as you have seen in the trading multiples breakdown and the growth rate and really understanding how all of them feed into the data point, Alphabet is not as expensive as it seems on an operating income multiple. Yes, it definitely did expanded a little, but it essentially went back to the higher range of its historical band. Free cash flow did take a big hit like most hyperscalers. And yes, for a like-to-like comparison, you might naturally feel that they are very expensive. Alphabet, these are the numbers that we're working with. 31 times PE, 21 times price to operating cash flow, and 51 times price to free cash flow. Meta platforms, you take everything down a notch. In fact, I'm looking at the price to operating cash flow and the 15 times cash flow. I think it's relatively cheap, all things considered. And clearly, Meta is also trading at near the lower end of its historical band. But I think one of the more important things that investors tend to forget when making some sort of this kind of comparisons is that the genetic makeup of these two companies are relatively different. Although I know that a lot of people like to compare that one is the king of advertising and one is the queen, and they're all juggernauts in their own rights. But Alphabet, not forgetting that they're a much larger enterprise, they're far more diversified, and they have a lot more optionalities being built into the business that are closer to fruition. So you can think of the different business arms like cloud and even Waymo. Versus Meta, that is a lot more focused and a lot more vanilla in terms of where they drive their income. And of course, potentially some other optionalities on their VR and AR glasses too. But in terms of the trajectory, in terms of the levels of commitment and development, it's still a far cry compared to Alphabet per se. So I can understand also why investors like to compare between the two, but I think we should still focus on doing a bottoms-up valuation and understanding the business fundamentals for the two of them. I think a good rule of thumb here is that you own these two companies because you like the business and you want to bet on their individual future and direction. Don't buy one of them over the other just because it looked cheaper. Now, back to the question for myself. What if I already own both of them in my portfolio today and one has recently run up by so much so quickly? Do we sell some of it to take profits, hold it into cash, rebalance to other position, wait for a pullback, or even sell Google and buy Meta? And clearly, I can't make the decision for you, but for myself, I think it's quite clear that I want to hold both companies for the long term. And I do feel like I'm still severely underallocated to Meta at currently roughly a 3% exposure. And I will want to add them more in the near future. And I'm basically just trying to time the market and waiting for good entry points. And to address the existing Google position, I also can understand why some investors might potentially want to lock in some profits first, which I think have no issues in and of itself. So I'm not really worried about the short-term fluctuations. But in the short term, however, I might consider rebalancing a little bit from Google to Meta to keep the sizing in check. But the base case here will be to constantly increase my exposure on both companies in the longer term. I'm not in the hurry to kind of quote-unquote lock in gains and to keep it into cash. And even so, if let's say I talk about rebalancing or selling or booking in a bit of profits from Google, I believe that the cash will be immediately redeployed. But it's not so much because I think that Google is expensive and I'm trying to trade in and out of the position. It's more portfolio allocation. So with that in mind, I hope I gave you a simple framework to understand these two companies today in their current market position, in their current valuations, and how I think about both of them. With that, I'll see you in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye!